Hello everyone, Dave Landry here from DaveLandry.com. This is Trading Simplified. The market is providing us with a lot of really good examples right now for trend following at its finest and a little bit at its worst. And I like to show you everything warts and all, as you know. By the way, housekeeping, I do take requests. You can send them to DaveLandry.com/contact. This particular show is somewhat limited as far as the amount of time I have, but on Thursdays, I give myself a little bit more time and it doesn't fit into a perfect time slot. So I will have time to cover a lot more things and details if I can't cover them here. And you can go to those shows, you can attend those shows live at DaveLandry.com/webinar. Register even if the webinar date is old and you'll be registered for the next couple of years. If you want the slides from this presentation, all three of my books in PDF format, limited access to the members area, and enough stuff to keep you busy for a long, long time, go to DaveLandry.com/StockCharts and put your information in. All right, let's talk about the mystery charts and the methodology in action, especially given the nature of this market. Now, we talked about this one over the last couple of weeks, and the reason it's not a mystery chart is because I mentioned it in Dave Keller's The Final Bar, and it was also a setup for my service peeps, and we did enter here. Stop is here, and then we did bump the stop a little bit. In hindsight, I probably should have bumped it a little bit more. I did, and it was just completely by accident. And believe me, I make a lot of accidents that don't go in my favor, and I do a lot of fat fingering that doesn't go in my favor. But in this particular case, I was able to exit half of my shares. I still have on half of the shares at a loss because I'm trying to mimic the trading service as much as possible. So at the lows recently, you can see it had a pretty big swing in equity. We haven't quite stopped out yet, and this one might stop out at a loss. So far, it's not looking so good. But I want to show you it, or continue to show you it, as an example, just in case it doesn't stop out. And I want to use that as an example of not micromanaging. And that'll make a little bit more sense with a little bit better example, I hope. And I know you should never say hope in this business in a few minutes. Now, I want to talk a little bit about understanding a trend following system with a very simple system, the trend following moron 10% system. Lately, for some reason, I've been flooded with a lot of calls from friends and long lost friends, and they're looking to do some trading. And what I try to explain to them is that the market trades on emotions when they're trying to put some sort of theme together or whatever. For instance, someone called me just yesterday. They wanted some inflation plays. And I'm like, well, inflation might be here and it might be masked by the government, which is his theory. And it probably is. I mean, I've just bought a thing of cream and it was $7.49. Anyway, what I'm telling these people is what is. And so far, interest rates, at least lately, have been going down. Don't confuse the issue with facts. If the market is going up and it fits your theme, then by all means, play that theme. And I talked a lot about themes in last week's presentation, so go in and look at that. But I thought a good way to show how trend following works is through just this simple little trend following moron 10% system. Now, I've been asked before, this one person said, surely you have some long-term investments and not everything is trading. And my answer to that was, first of all, stop calling me Shirley. And second, well, I'm willing to stay with the market as long as it moves in my favor. So when somebody says, what's my holding period? I'll say 10 years, hopefully much longer. In fact, when we get to some of the trend following stuff in a few minutes, vis-a-vis the core methodology with the portfolio, my trading service that is, you'll see that we've been in some stocks since last summer. And I'm hoping that will be in the stocks next summer. But anyway, I wanted to show this particular example of using something really simple when it comes to trend following. So getting back to the question that I was asked several years ago about having any long-term holdings, and my answer was no. This, I guess you could kind of say, well, this could have been a long-term holding, but like everything I do, I like to get out of the way when things began to get a little iffy. Now, we've covered this system before, and I want to talk a little bit about it when it comes to the overall market vis-a-vis the S&P 500. But we want to buy when it's above the buy line, which is simply just 10% below the 50-week closing high. So you take the 50-week closing high, and then you subtract 10% from that, and that gives you a buy line. So as long as you're above the buy line and you have 2 bars of Landry light, you buy the market, and then you sell when it closes below the moving average and the buy line. Now, as I've said many times before, the sell signal a little less stringent because you want to sell first and ask questions later. Now, I normally don't trade mutual funds, but long story endless, I got into this fund because it was some inherited money, and the people who were housing the money are kind of kind of jerky, and they wouldn't let me move it around or anything, so I'm kind of forced to do whatever with their funds. These are qualified funds. And anyway, I saw they had this hard assets fund, and metals and mining seemed to be doing pretty good at the time. So I went ahead and bought it, and I said, well, I'm just going to exit when the TFM 10% system has a sell signal. So you can see, bought it way back here in September and caught a pretty good run in this, and just sold out on Friday, or actually put the order in on Monday for Monday's close. Signal was on Friday. Now, one thing I did actually make a mistake with, this is a 30-day EMA, and this is 30-day Landry light. The sell signal would technically be a little bit lower, about a point lower, and I might have made that mistake. It's one of these psychological mistakes you made just because I didn't want to be in this particular market, or I'm not really a fan of this particular company that houses these funds. So anyway, long story endless, way too much information. But the point is, have a system in mind when you're trading stocks. Now, it's also good to have a system in mind when you're looking at the overall market. Now, in individual stocks, obviously I trade things a whole lot differently, but I did want to show you this example as a way to time a market. And speaking of market timing, I think it's important that you use market timing for the overall market. Not that you want to exit all your positions when the market gets a little iffy, and I'm going to explain that in just a few minutes, but rather think about getting out of the way and possibly think about shorting the market if you're a little bit more advanced when you begin to get a sell signal. So you can see we had a TFM sell signal way back here, right when everyone began to take the pandemic very seriously, okay? And then we had another buy signal back in July. Now, it took a while for this buy signal to kick in, and that's because this was such a V-shaped recovery. This particular system takes a while to start dropping before the buy line, that is, before you're able to get in at lower levels. If you go and look at 2007, 2008, when we had a really serious bear market that stayed down for a while, this buy line caught up and you were buying at much lower levels. Anyway, I wanted to show you this system, and you could argue that if you got out on the sell signal and got back in, you're actually getting it a little higher than you got out. And you say, well, Dave, that's a whipsaw, right? It's like, well, if you look at where the market was and you look at where it ended up, this feels a lot worse than it looks. And a lot of people who held through this are thinking, man, I'm glad I held on. Well, the market is a really bad teacher, and buy and hold, believe me, is a bad idea, and I'll touch upon that a little bit in just a few seconds. The thing to think about when timing the market, when I was talking a lot about market timing a while back, is that market timing is less about beating the market and more about not letting the market beat you. So if you're getting ready to retire and the market drops 50%, well, it might take 25 years for that market to come back, believe it or not, okay? Don't believe me? Look at the charts going way back in time. Anyway, it can be demoralizing to lose half of your retirement right when you're getting ready to retirement. So I think that everyone should implement a little bit of market timing, even though you occasionally get a bit of a whipsaw. And I think Greg Morris said it the best. He was visiting a few years back, and we got to talking about market timing. I know you probably want to party with us. He's actually fun to party with, by the way. We don't just talk about markets. But anyway, long story endless, he told me, he said, well, Dave, whipsaws are frustrating. Bear markets are devastating. You could survive frustration. And when I reread his book, Investing with the Trend, I noticed that he had that quote also in his book. So it's like, okay, that's a little frustrating to get out of the market and then have to get in a little bit higher. But believe me, it's a lot better than riding this thing down 30% or more. And the reason I put this feels a lot worse than it looks because my phone started ringing off the hook when the market was down 20 and 25% and 30%. And a lot of these long lost friends and family began calling me freaking out. It's like, well, the bomb's already blown up. Anything I do at this point is probably just going to make things worse. Now, I grabbed part of the spreadsheet to show where we are in this system, and I want to show you where the next signal will likely occur, all things constant, which obviously markets change day by day. But you can see that since the last signal, it's up 32%. So that's a pretty good run based on the last buy signal we had back last year and last July. So far, this simple little system, as you can see, has been in the market for over a year. So trading is not always just about in and out, in and out, in and out. Although I do probably do a little too much. I call it intraday trading. Day trading has a bit of a bad connotation. I try to get in the mornings as early as possible and ride the trends all day long. And I do that on a small portion of my account, kind of an S&G type of thing. And I think that these ancillary trades like that, you can make a little money doing that. I talk a lot about that in the weekly charts, and I'll probably cover a lot of it in Thursday's show on the 22nd, I believe. Because just because there's been a lot of that lately. But anyway, before I digress too far, I know too late. If you notice some of these numbers in here, and the header is chopped off, but this is what I call the diaper change moment. And like I just said, the last spill, this is after you exit, okay? So you exited at a 9% profit, which is not fantastic, but better than a poke in the eye, right? 9%, nothing to sneeze at. But then you avoided a 28% loss. Now, the market did come back, but you didn't have to live through that 30% slide, round numbers, just like you didn't have to live through these 50% haircuts, round numbers. You had the, 2000 and then 2008, and you go way back in time in the 70s. And then, of course, if you go all the way back to the Depression, there was a 90% haircut in the overall market. Now you're thinking that was then, this is now. Well, NASDAQ lost 70-something% back in 2000, and that's, believe me, that's nothing to sneeze at. So I took this snapshot a few days ago, and this is a weekly chart, and this is what the system uses. And this is using my ACP plugin, which is 100% free. I can't help you with your ACP subscription, but the plugin is free. All you have to do is like this video and you get a free plugin. Hey, can't beat that, right? Anyway, the point I wanted to make with this particular chart, and I put it up on Facebook, is that the signal is still a ways away. Even with the recent spill we just had, we're still not quite there. So plot your 50-week moving average, and if you have ACP, get my plugin and plot the buy line, which is 10% below the 50-week closing high, and pay attention to that. And I think once we get a signal, or if we get a signal with this, eventually I guess we will, hopefully 10 years from now, then you might want to think about lightening up, maybe honoring your stops, and again, for the more advanced, possibly considering some shorts. Now, I know I've kind of rushed through this system, but I've covered it in a lot of detail in previous presentations, both here in my Trading Simplified shows and on my YouTube channel, www.youtube.com/c/Dave Landry. So check those out and check out my website. I do cover this in the market timing course, which you'll get free with that link that I showed earlier, davelandry.com/StockCharts. Now, I want to shift gears and talk about some of the nuances and some of the downside of trend following. Now, by the way, the only way to ever make money on a trade is to what? Capture a trend. Never forget that, okay? No matter what methodology you're using, once you get in, a trend has to develop. That always kind of blows me away when you think about it. I know I'm a nerd. It can be streaky, and as I've said 1,000 times, a friend of mine, Peter Marthy, invited me to present to a group of traders in Dallas probably 10 years ago. And after the presentation, he gave me some constructive criticism. He said, you use the word streaky, you make it sound too elusive. And I really thought about that over the next few days, and it's like, it can be streaky, and that's the reality of it. You go through a print money phase for a while, And then for a while, you can't seem to hit the side of the barn. I think it was Gelber that once said the life of the trader is 3 months out of the year you're hot, you're so hot you can't sleep at night. 3 months out of the year you're cold, you're so cold you can't sleep at night. And then the other 6 months you kind of grind it out. Win a little, lose a little, win a little, lose a little. Well, that could be trend following pretty much in a nutshell. One of the things that can be tough is you must be present to win. And there's several examples here that I've said redundantly, or over and over, I should say. Ad nauseum is probably the word I'm looking for, or phrase. Is that one time, for instance, somebody emailed me and said, I'm just going to take a little vacation. I'm going to stay on your service, Dave, but I'm not going to trade for a while, and I'm just going to go off and have some fun. Because I don't see any setup setting up, and I don't see how any could set up for a while. And I'm like, well, I can't disagree with you there, but I'm stuck here doing my service every night. And that night I found 2 setups, which turned into 2 of the bigger winners of the year. Now, I didn't want to email this guy and say, hey, did you take these? Because you said you were quitting. I didn't want to rub salt in the wounds, but I'd be willing to bet that he didn't, because he gave up on the trend following right before the big trend happened. Outliers are key. I see this happen all the time. Somebody complains, I can't make any money with your service. It's like, well, did you get this stock? We just made $25,000 in this one stock. Doesn't happen every day, obviously. If it did, you'd never see my $5. But I digress. They're like, no, I didn't get that one. It's like, well, did you get this other one? We made $5,000 over here. That was pretty good, right? No, I didn't get that one. It's like, well, what did you take? Well, I took all those turds you recommended. It's like, oh, great. So sometimes 1 or 2 outliers are key, and I'm going to touch upon that in just 1 second. Now, the other thing is it ends badly, and I'll explain that in just 1 second. Now, before we get into that, let me just explain something really quick. While we're talking about problems, and this is something I talked about in last week's Week of Charts, so you can find that on YouTube or my website. But when you get into these positions, even though you're taking partial profits, in this particular case, we got in 1,000 shares per 100K, so let's just keep the math easy, and that's what I keep the model at, right around 100 to keep the math easy. You would have bought 1,000 shares of the stock. So way back when it's right around low double digits, a 10% moves about $1, and you multiply that times 500 shares, so you see about a $500 swing in your equity on 100K. So that's about a 0.5% swing. That's significant enough, but it's not going to kill you, and it's not going to really stress you out too much. But when it gets to $50 and $60 a share, you're looking at a 10% move of 5 or 6 points, and that's like a $3,500 swing in equity, or a 3.5% swing in equity. So that's pretty painful, and we felt a lot of that pain recently. In fact, we just stopped out of this particular stock, and I'll show you. I'll use it as an example of ending badly. Now, the thing you can do to help alleviate this problem, because if you think about this, if you bought 1,000 shares down here at 7, that's like putting up $7,000 margin. Well, even though you don't have to put up more margin because the stock went up, when you were up at $60 a share, that's like having $60,000 in the account. Now, we do take partial profits, so that would be $35,000. That's still a lot of money to have in one particular stock. So one thing you can do is you could actually scale out of a little here and there, maybe 100 shares or so, when the market, or when the stock, I should say, is having a really, really good day. And that's one way to kind of mitigate those swings. Of course, if the trend continues for a long, long time, then, of course, you wish you have those shares. But, you can't have everything. If you did, where would you put it? And I think that's right with a W. Anyway, I want to show that example real quick. Now, getting back to the ending badly, George Carlin once said, when you buy a pet, it's going to end badly. And my corollary to that is when you make a trade, it's going to end badly. If you're trend following with a trailing stop, you're going to give up some open profits in the end. It happens. It comes with the territory. So what happens is either one of 3 things. You buy the stock and it fails miserably and you outright lose in the trade. You buy the stock, it has a pretty good rally, it hits the initial profit target, then you scratch out. That's what I call the better than a poke in the eye. You make about 1% overall in your account with that. Better than a poke in the eye, right? And then the other thing that could happen, which is the ideal scenario, is that you catch a trend, you get your initial profit target out, you ride the trend, but then eventually stop out. In the end, you lose some of those open profits. You have to be willing to lose those open profits, though, if you are ever going to make any money in the market. So this is the CPE example. We got in 1,000 shares per 100K at $7.12. Flipped out half of those at $8.60 a few days later, about a week or so later. And then we stopped out the remainder via a trailing stop at $42.70. So it's $9.25 in the first loaf and $22,238. Now remember, this is on a hypothetical 100K. I do take these trades and I do try to mimic them best I can. So I'm not just telling you about something that I won't actually do myself. And if you add that up, it comes to $23,163 in initial investments. The initial portfolio value was $100,000 when this trade was initiated. 1,000 shares at 7 and change. Now, the thing to think about is, did you make $23,163 or did you lose $8,400? Because if you're mentally monetizing your trading account, you're looking at that equity, and then all of a sudden the market begins to tank like it just did, you're a hurt and pop. But you have to look at what you made overall on a net basis, $23,000. If you could do that every now and then on one stock and not on a whole lot of shares, a $7,000 investment, if you look at the investment as the margin, and reality is we had a stop to where we would stop out at a $2,000 loss. Now, you're not always guaranteed a maximum $2,000 loss, but that was the idea. So you end up making $23,000 and your risk was $2,000, provided, of course, you would honor that stop and it didn't gap through the stop. I know quite a few ifs in that sentence. But the bottom line is, yeah, it ended badly, and it always is going to end badly. And you know what? I drop a lot of F-bombs. In fact, I should be on camera today, but I'm looking a little rough. But I've got on my F-bomb shirt. I call it my trading shirt, and I wear it quite often. Now, I want to shift gears real quick and talk about what happens when the market begins to slide a little bit. When you start seeing some signs of deterioration in the market, and if you go back and look at the service archives, I'll put a link in post, you can go in and see where I talked a lot about the trend deteriorating recently and a lot of sectors beginning to break down. And you can watch the recent Market in a Minute for a lot more on that. So the market recently has gotten a little iffy, and it might still be a little iffy. Now, does that mean you rush out and sell all your positions? No, you honor your stop and you continue to follow the plan. So one of my friend's wives, he just has one, but anyway, she texted me a couple of days ago. I just stopped out of ASO. Did I set my stops too tight, 50%, or honor it? So my answer was, if only you knew someone who had a trading service that posted suggested stops. So this particular stock, ASO, was in the trading service, and I'm guessing that that's where she got it from, and the stock began to slide a little bit, so she decided to bail out. In other words, she micromanaged. Now, micromanagement pays over the short term, but rarely longer term. So if you look at the trading service, the stop was at 33.50 on ASO, okay? Now let's take a look at that in the chart. So stop is down here. She's out of the market. Now at the time I'm doing this presentation, the stock's up a couple of bucks. So it looks like it's already above where she got out. Now, it's quite possible this thing could have kept dropping like a stone. In fact, for a day and a half, I was thinking, oh boy, maybe she is right on this. And I decided, however, to follow my plan. And believe me, following the plan is not easy. Sometimes for me, it's easier to follow the plan when stocks are in my trading service. And that way, I already have the plan laid out, and I know my people are supposed to be following the plan, so I too have to follow the plan. But yes, for a while, it looked like it was going to be one of those in badly situations. And you could see we've given up quite a bit of the open profit. But my point is to stay the course. So when the market does get iffy, you're probably thinking, should I stay or should I go now? And I would say stay. Just follow your plan. Don't throw caution to the win. Now, if you look at the old portfolio, this one got whacked today, so we have to put another loss on the books. I know, shocking. A guru that has showed you a losing trade. But we'll see, and maybe this ASO that we just talked about will continue to rally. Maybe this APG, which came fairly close to stopping out recently, might continue to rally. And all we need is one of these really to just take off nicely to make it all worthwhile to pay for some of the ones that didn't work out. Now, along the lines of understanding trend following, someone recently started my trading service and they were with me for about a week and then they decided to quit. They said they're disappointed with results. And as I read further into the email, they were talking about June through October. I'm not sure why they picked that period in 2020, but they looked at that period. They were kind enough to leave me a little feedback. And this is something I talked about in a lot more detail last week in the weekend charts. But anyway, the months I looked at did not appear to be that difficult in terms of volatility or tradability. So I grabbed the chart from last year and I looked at it and I thought, oh shoot, looks like the market went up. And then I said, well, wait a minute, Dave, let me just take a look at June through October. Well, the market was up 7% during that period. But if you look at how it got there, it was a bit of an electrocardiogram, sans that one little trend in the beginning. And what's even more interesting is if you look at the high, if he would have started his tracking just a few days later, you could see that in June, July, August, September, October, 4 or 5 months here, the market didn't go anywhere, at least from the high to the low at the end of October. So I'm not going to bore you and go through this right here, but this is on my frequently asked questions about the service. And this is why I don't publish official results, but I do occasionally address things such as this. So if we look at how the service did over that period, we actually lost 9% or $9,000, as you could see. Now, that's not that good, especially since the market was up 7%. But again, the market was kind of all over the place. Now, the good news is one of the stocks that we were in over the next few weeks went up $5,400, $5,481, and it stopped out at a $5,481 gain. So that goes a long ways toward making that $9,000 loss go away. Now, I got to think about it. What would happen if I went back to last June and fast forwarded all the way to this June to see how things did? And you could see the period back here this gentleman was talking about. It wasn't so hot. But you could see that we came flying out of that. And this is a little bit exacerbated because there's a few big closing trades, a $28,000 trade, for instance, that we just closed out in the aforementioned CPE. But anyway, you could see that trend following when there's no trend doesn't really do that well. I think it was Greg that said in order to follow a trend, you must first have a trend to follow. But anyway, I just want to show you this real quick. I went through a lot more details of this, and this kind of illustrates the streaky thing, the fact that you have to wait sometimes for trends, as I often preach. This could be 6 to 8 months and occasionally longer. Now, here are some of the thoughts that I talked about in last week's show. So I would recommend you go in and watch last week's weekend charts, and I'll put a link in post. But here's some things that I think would really make a big difference: compounding, discretion, and obviously it does take a while to capture a trend. So I'm just kind of scratching the surface here, but trend following is great in that it's the only way to ever make any money in a market, any real money at least. And the only way to make money on an individual trade, obviously, is to capture some sort of trend. But it does have a lot of nuances. Well, that's my time for this week. I want to thank everybody for watching. Again, you can go to these links for follow-up information, or if you need to contact me. So once again, thanks for watching, and may the trend be with you.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.